Last year was a challenging year for both global and local markets. For 2019, the Philippine stock market was up by only 4.68%. Will 2020 paint a similar picture, or will we finally have a recovery year? Let's find out. I'm Reynal, and here with me to discuss where the markets are headed for the next few months is Jun Tarrobago, ATRAM's head of equities.
Thank you for joining us, June. So, June, the Philippine equity market seems to have struggled towards the end of 2019, and year-to-date we're actually down by almost 5%. What's happening, and should investors be concerned?
What's happened is recent news against Maynilad, Manila Water, and more recently, Ayala Land have raised concerns on regulatory and political risk in the Philippines, triggering net foreign selling of about $82 million and caused the Philippine Stock Exchange Index or the PSEI to slump about 4.5% year to date. So that's about a drop of 5.1% in US dollar terms, making the Philippines the worst performing among Asian equity markets, which are generally up by about 3.1% year to date. This has caused positive market news, such as the signing of the amendments to the Real Estate Investment Trust or REIT implementing rules and regulations, or the REIT law, going almost unnoticed, despite its favorable implications for the real estate sector and the economy. Foreign investors now are either selling Philippine equities or adopting a wait-and-see stance. Hence, the PSEI, in our view, may continue to test significant support levels, now at 7,366.52 points. That's about 1.3% lower from current levels, or more significantly at about 6,843.83 points. That's about minus 8% from current levels. That's the strong support level of the market.
So, given all these uncertainties, is the Philippine equity market still attractive for foreign investors?
While negative near-term sentiment lingers as concerns on the sanctity of contracts and the economic destruction from Taal cannot be ignored, and as technical charts flag further downside potential on the market, as mentioned earlier, we do believe that the PSEI has significantly priced in the heightened risk. The average price-earnings ratio or P ratio of the market has dropped to about 14.5 times, which is way below its historical average of about 19 times. This indicates that the Philippines has lost its historical premium to the MSCI Asia ex-Japan Index, which is the benchmark for Asian stocks, which trades at about 14.2 times, 14.3 times. Also, the average foreign ownership levels for Philippine stocks have dipped to close to 10-year lows. Average foreign ownership of common stock in the Philippines is now at about 23% as compared to highs of about 31% over the past 10 years. All that while positive Philippine growth fundamentals remain intact. So we want to stress that, as GDP is expected to grow above 6% and as corporate earnings are expected to sustain double-digit growth momentum built from 2019. That said, the release of actual Philippine first quarter 2020 GDP numbers and corporate earnings reports may validate the strong growth story for the Philippines and, barring external shocks, deliver a recovery in sentiment and a rally towards our fundamental, not technical, index targets.
Taking into account the near-term risks and negative investor sentiment, yet fundamentally sound macro story, where do you see the index is heading to in 2020?
To account for the heightened risk, our base case index target is 8,670. So we've reduced it by about 7%. This is equivalent to about 17 times price-earnings ratio, which still implies upside of about 16% on the current market level of about 7,466.65 points. Assuming domestic and external uncertainties ease, our index target for the PSEI target could go toward our best case scenario, which is 9,690 points. That's an upside of about 30%. However, if domestic uncertainties further escalate and warrant a discount for the PSEI against Asian peers, we may see our index going lower to our worst case scenario, which is 6,842.83 points.
And as of now, the index is actually trading at 7,475 levels. So June, is it time to buy?
Well, from an asset allocation standpoint, the earnings yield of the market earnings yield is the inverse of the PE, has now risen to about 6.9%, making Philippine equities attractive against fixed income and other asset classes. So based on fundamentals, the market risk-return proposition for the Philippines, or the PSEI, has become more compelling, with the upside of 16 to 30%, as mentioned earlier, against the downside of about 8% on our worst-case scenario. So from, again, a risk-reward standpoint, we think it's prudent to buy Philippine equities selectively on weakness.
Given that, what sectors or specific sectors do you think look promising and you think we should be closely monitoring for 2020?
We continue to select names in the property, banking, industrial and construction and consumer sectors, especially those that are direct and indirect beneficiaries of the Philippine infrastructure growth story. I think those are the key sectors to monitor, which may possibly or likely outperform in 2020.
All right, thank you, Jun. Now that we've heard the outlook for Philippine local equities, let's hear what ATRAM's head of fixed income, Miguel Liboro, has to say about inflationary themes and foreign exchange.
Good to have you, Miguel. So this 2020, what do you think will happen to interest rates?
Well, 2018 and 2019 had very clear directional trends for interest rates. In 2018, it was one way going higher, and in 2019, it was one way going lower. Now, both were largely driven by inflation and how the BSP reacted in these cases. 2020, I feel, will be a little less clear-cut. We don't have that same clear directional trend that we had over the last 2 years. And what that means is that we're expecting a little bit more volatility to return. But amidst that volatility, we're going to have some opportunities. And I think we're already beginning to see this volatility being borne out just in the first 3 weeks of the year.
I see. So how do you expect key macro data to pan out in 2020? And what will this mean for our bond portfolios?
Well, we are already seeing inflation rebound from the sub 1% lows that we hit in 2019. This was expected. And consensus view right now is that it will remain within the BSP's 2 to 4% inflation range. But it must be admitted that there are upside risks to inflation moving higher at this point. One of which is the escalating hostilities between the US and Iran. So fears that global oil prices will continue to move higher and stay higher, which is inflationary. But I guess more importantly and much closer to home, the recent eruption of the Taal volcano, which, while we're not 100% sure on the longer-term inflationary impact, should pose some supply shock risk in the short term. These factors lead us to believe that there is some risk to inflation moving higher, although we don't think, based on this information that we have now, that we're going to have a return to the very high levels that we saw back in 2018. As active managers, we're always looking not just at ways to maximize the return of a portfolio, but in a weaker market, how to mitigate potential losses. And as you know, when inflation goes up, that's bad for our bond portfolios because it reduces our real interest rate and causes the bond prices to move lower. So if we feel that the tide is turning towards a much more quickly accelerating inflation, then we would reduce the risk to try and protect on the downside.
Okay, as for foreign exchange, where do you see the peso is headed to?
We expect the peso to depreciate against the dollar this year. To be honest, I thought it was going to happen last year. But last year's appreciation of the peso, I feel, was less to do with peso strength and more to do with broad dollar weakness. Now, I don't think that broad dollar weakness has dissipated much, but we had a US Federal Reserve which was cutting rates aggressively last year, and we don't really see that to be the case this year. So we feel that some of that dollar weakness is going to be tempered, especially when you have that in conjunction with the Philippines really ramping up their build program, increasing imports to try and catch up on the GDP and the growth front. We do feel that there is room for a modest depreciation of the peso against the dollar, and we're looking at around 51.50 to 52 at year end.
Okay, given all of this, so what's your year-end outlook for global and local fixed income?
For the local fixed income market, we're expecting a little bit of an adjustment higher due to inflation. Now, actually, over the first 3 weeks of the year, we've already seen a bit of that adjustment. But given the view that inflation will gradually move higher but stay within that 2 to 4% range that the BSP is projecting, we anticipate a little bit of a move higher in rates, but at a more gradual pace, and allowing the market the opportunity to recover and stabilize. And amid that environment, we're looking at a more modest return compared to last year of maybe 4 to 5% at the end of the year. On the global fixed income front, while we don't have that same inflationary kind of consideration in a big way, we do feel that rates are going to be range bound. And this is really because we are still living, I feel, in a lower for longer interest rate environment globally. There are myriad geopolitical risks that still exist. We could see a flare-up at any point in time, again, of US-China trade tensions, of the US-Iran hostilities, or concerns on global growth slowdown, or a China hard landing. And all these things could just come into play again. And that would cause a lot of volatility in global markets, and in global fixed income especially, because when risk markets are, when it's risk off and risk sentiment is poor, there's a flight to quality, and investors tend to put in a bid or try to buy US treasuries as safe haven assets. So we're seeing that type of volatility this year, and we think that because of that volatility, there will be opportunities in the global fixed income space. Apart from that, if you are a peso-based investor, given a year-end target of 51.50 to 52, based on where the peso is today at around 51, that's a good 1% to 2% potential upside just on the currency. If you combine that with what we feel we could make on the global fixed income side, then it can offer a fairly attractive proposition to an investor.
Thank you, Miguel. So there you have it. I hope this video has helped you learn more about the markets and our outlook for 2020. For investment updates and expert advice, trust ATRAM. If you found this video helpful, please like and share this video, follow us on Facebook and Instagram, or visit us at www.atram.com.ph.